Monaco 64, home of alternative economics and contrarian views. Well, Happy New Year to everyone. We are recording this interview, though, on the 31st of December, New Year's Eve, and I couldn't think of a better person to have on than David Jensen to talk about what's going on in the silver market. Hi, David. How are you?
I'm well, Mario. Great to be back talking about our most interesting subject.
That's right. And I mean, we saw today that Comex is desperate. They hiked the silver margin again, also gold, and I think platinum and palladium, but silver much more so.
Yeah.
Yeah, and the last couple of major bull markets in silver back in 1980 and 2011. They used these tactics as well, and they were able to bring silver to a halt. The silver price back in 1980, they stopped people from buying contracts. You could only liquidate, which is a really great and fair market, right? Free market. And
Yeah.
then in 2011, they hiked margins massively, and then JP Morgan also smacked the silver price. But I'm not too sure this time around that they have the firepower. I mean, they can keep raising margins, but if the world wants physical,
Uh-huh.
and also, David, we've gone through 50. If they really wanted to stop silver, they should have done this back in October when we are breaking 50, but they didn't. And I think the rest of the world now knows what the game is, and that's why they're having so much problem. Maybe you can talk about what the game really is. I'm sure you know it. I've learned a lot from you as well. And for the viewers, David, he's been on the channel several times since early 2024, and he's been warning about this. And I have a playlist up here, a David Jensen playlist, and you can look through the videos. So I'll stop talking now, David.
Okay, I'll start. So the issue for me, well, not for the issue, I think the central issue is that this is not a New York problem. This is not a New York pricing issue. It's not a New York market issue. It's a global issue. And the part that I don't see being discussed, and I think it's the central theme to understanding the complex of the silver market, is that the problems that we saw in London in 2025 revealed that it was basically an empty vault in terms of physical availability to the vast majority of the contract holders for immediate delivery of silver. And what has happened is that there's been beneath the surface or sub rosa fanning out, if you want to call it that, of the holders of these contracts to source silver from whatever source they can get it once the realization was um, that the silver that was said to be in these vast vaults in London was really just a chimera. And so what we've had is the scouring of all of the markets globally to secure physical silver to to replace the empty promises or the uh, 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 greatly devalued contract positions that there are held in London. And so the thing to keep in mind, I think that the in terms of scale, like how big of this of a problem is there a in engineering, you do a first order analysis when you encounter an engineering problem. It's like, what are we dealing with here? What is the scale? What are the forces? And so when we look at this silver market situation, we say, well, using the latest figures from the LBMA of the London silver market, and by the way, the LBMA is not a market; it's the London silver market where the trading happens. But the LBMA posts these figures stating that they're trading over 700 million ounces a day on an active day. And that translates into billions of ounces of claims in London. And when we consider the fact that UBS said a couple of months ago that they were upping the the silver supply deficit, the physical supply deficit in 2026, their estimate was 300 million ounces. And then you say, well, wait a minute, if these contracts are basically the contract claim holders are departing the London market and going elsewhere to source to markets where they can actually source actual physical metal. You've got billions of ounces in London. You could have the deficit, the true deficit in 2026 being multiples or even many multiples of the 300 million ounces that were projected. And this can happen in a and it appears to be happening in a very, very quick fashion. We've seen the price escalation, and I mean, it's hard to wade your way through all the information that's out there. It's like a shotgun blast of information that's out there, and it hits you every day. And it's like, what is the essential issue here? And I think that the core of this issue is the fact that the run is on to secure bars, given that the veil has been lifted, or the curtain has been pulled aside, to use a Wizard of Oz analogy, in the London market, Mario.
Yeah, I read your latest article on Substack, and I'm just gonna share it quickly here with you and the viewers. Gonna bring it up. And I recommend David's Substack. I'm going to put a link below in the description. It's Jensen's Economic Precious Metals and Markets newsletter. Uh, you talk about Asian guy's sudden silver story and bullion banks shorting big silver still. So, yeah, basically, you're saying the heart of the problem is in London, but on Comex, they keep shorting silver, the bullion banks, and we saw today. 31st of December, David, which is going to be a quiet day for the markets. Most people don't even care what happens, but we're looking at this closely. The Federal Reserve Bank of New York, they lent out overnight repos to the market, to probably to the bullion banks of 74.6 billion, which is huge compared to the recent numbers. And if you compare it to last year and the year before, there's no Fed repo activity at the end of the year. So yeah, London's the heart of the problem, but how does Comex fit in, and why is Comex so adamant to stop silver going higher above, let's say, 80? It seems to be their level now.
Yeah, I mean, I look at the Comex as a marginal player in all of this. It's not the dominant physical silver market. It ultimately, Mario, and by the way, maybe we can call this conversation Italian guy and Danish guy
Yeah,
as, a,
that's
as,
right.
an, as an alternative to the Asian guy. Um, so yeah, New York, I really view it as a marginal player. It was never meant to be a physical market. It is rapidly becoming a physical market. Somebody told me something that they should raise their margins higher to force it into, to 100%
Yeah,
to
that would be a physical market.
exactly. And that's what the world is becoming physical, right? This is what is happening. There's a transition going on. And we're going from a world of digital or vapor promissory notes to demand for delivery. And as I stated here at the outset of this discussion, I think the key issue is that rapid this rapid deployment of capital to get the silver while you can, because there's been a revelation. And of course, with learning processes, not everybody learns at the same rate. Not every holder of a cash contract in London understands what's gone on. And they believe the narrative, which has been continually fed, that this is just a logistics problem. right? There's a flow problem. That's heavy bars. There's, disruptions, and we can't quite get the delivery going. But what was revealed was basically that London can only make delivery when it gets delivery first. It's not a massive repository. We saw, multi-month delays in the beginning of the year, and then we saw basically a seizure in October. We saw exactly where the bottom of the barrel was. And we know that from the latest figures that we've got from London that there's plus or minus 50 million ounces above the bottom of the barrel, but we don't even know of those 50 million ounces how many are available to market. So these cash contract holders are now fanning out, and the distress, it's just remarkable how quickly the distress shows everywhere in all the world's markets, including in New York. And I really see this as a King Canute type of effort at the very end to fight against the tide that's coming in. It's interesting, the volatility. When you look at the volatility index for SLV, it's right now it's about 66. But to give a sense, like in 2021, it hit 138. And we haven't been anywhere near that level. And yet these tremendous efforts are being put in to flush people out, as it were, out of their Comex positions. And so, yeah, it really is it's a marginal story to me now, Mario, that the whole world has become physical. Um, the watchers of CNBC and all the other media, the Bloombergs and everybody else out there, readers of the Financial Times, will be the last to know. And that's for a reason, because they're not wanted to know that we have basically a sea change happening now in the global markets from what has existed through the 70s, and then was tremendously stepped up in 1987 with the creation of these promissory note trading systems there in London, which was at the time, the absolute dominant physical silver and gold market in the world. But I think New York and London are getting shunted to the side right now. And I think everything becomes local and everything becomes physical in the months and years ahead.
Yes, and you noted that the availability is uncertain of metal in the LBMA and even on Comex. Um,
Yes.
but we are always told by the mainstream economists and other analysts that are more mainstream that there is enough metal. Could you explain to the viewers why there isn't? Is it because this metal has been not just like parceled out many times over, rehypothecated for, let's say, the people participating in the futures market and in the OTC market in London, which is the LBMA, but also are they using these metals to like to back ETFs? Is that the whole problem?
Could you restate that last part about the ETFs?
Yeah, are they also using a lot of these supposed silver supplies, available supplies for like backing ETFs as well? Is that why there's a problem, you think?
Yeah, the net problem is a problem of leverage. And it's interesting that I think it was after Greenspan retired, he put out a note or a paper, he gave a speech about the benefits of leverage. And I've often reflected back upon that, because leverage in the end is absolutely deadly. And what I would say that they're not using the London stocks to backstop SLV or the ETFs, but Jeff Curry told us in 2021 that they're using the ETFs to backstop the exchanges. So the flip side of that, right? He said that they were buying and securing silver for the ETFs, and then in air quotes they were hedging this, because the lie there is that there is no hedging of an asset that's owned by a client, right? There's no burden on SLV or Larry Fink to hedge the silver. That is a risk that the shareholders of these ETFs take on. So yeah, so these highly leveraged markets in New York and London are basically in a rolling failure. That's a term that I've been trying to use to describe it because I want to emphasize the fact that nothing happens overnight, but it is kind of a washing out of the claims in these markets. And fraud is repugnant to the free markets. And so what you see is the rapid deployment and the rapid moving of capital globally to secure these metals. And then all of a sudden, we're seeing the culmination now of decades of misleading buyers of silver and users of silver and the many miners and manufacturers of silver in terms of the price. And so the supply has been greatly truncated as these global stocks of available silver have been consumed over the decades. And more than 60, I think it's 70% of the mine supply comes from base metal mining as a byproduct. And when you throw in gold, you're over 90% of the supply. So the supply chains can't even respond in a coherent manner now to the shortage that we're seeing. And there are very, very few primary silver miners out there producing the metal and making it available to market as the visibility of the leverage in these markets and what it truly means for those who need silver, comes to bear in the market.
Yeah, you said earlier that it's going to be a local, physical market now, but there will be some markets or exchanges that are going to be more dominant. Do you see Shanghai being one of those?
There's a lot of barriers when dealing with China, and I think it'll absolutely become a dominant one for China and maybe reaching into areas in China itself. But I think that what happens, we're going through a process of the fracturing of trust in the markets. And when you look at a trust curve, when trust is lost, it's a step change down. And then the recovery period is tremendously protracted and is a very, very gradual slope upwards. And I think that trust loss that's going to strike the global markets now is going to militate that uh, people deal on a local level with markets that they can ascertain are trustworthy, where they can actually knock on a door and show up and ascertain what is going on, or the representatives can go in and audit them and confirm that they're trustworthy. So I think that the fragmentation that we're seeing here is irreversible. People for far too long trusted basically chit chat about market security and the stability of markets and didn't dig into the numbers. They were, frankly, I don't want to be too critical, but there was a laziness involved here, both on the retail and the institutional side, and that you didn't have to dig too deep to find out something was wrong, but it's surprising how few people went below the basic veneer of the information that was available to the market and got into the rot and understood there was something very wrong. So that's a bit of a protracted answer, but the short answer is everything, I believe, becomes local, including the exchange of the metal itself as a private monetary unit to get away from these um, uh, I call them garbage government currencies, but the highly unstable units of exchange that are used to operate the market economy these days. They're going to call it a market failure. They're going to call it a failure of capitalism, but it was a failure of central planning because everything was taken over by the central planners, and there was a perversion that went on to distort the measures that the market economy needs to function. And we are here at the end game now of decades of market distortion by central planning and the extraction of wealth from the average citizens who basically have had their earnings destroyed by the continual price inflation, which has been uh, year after year after year, been gnawing away at their earnings, and at many of their assets. If you're a saver that trusts bonds.
Yeah, what do you think has been the trigger for this realization that silver is basically the silver market controlled by the LBMA and let's say New York has been like a paper fraud? Is it because you can only because you said some months ago here on the channel that they've been able to provide ample supply of paper silver, but you can
Yeah,
only do that for so long. I think it was even Jeff Christian once said that there's enough silver. It's like the Niagara Falls. But
yeah.
that seems to be now people realize when they really want the metal, it's not there anymore. What do you think has been the trigger? Is it the deficits, or is it also like the world becoming more multipolar and countries, different countries wanting to make sure they have the physical and not trusting like London or New York?
Well, yeah. So when we look at the total of the deficits, including ETF demand, there's issues there in terms of is ETF demand a true demand if they are reselling it into the market. I suspect that has stopped. I think Jeff Curry did us a favor by lifting the veil there. But when we look at the true global demand, we've had 7 years of silver deficits and over 1 billion ounces of consumption of the world's stockpiles that has led to the point, and if I was to choose one triggering event, as you call it, it would have to be October, November, December last year, as silver started to be transferred from London to the Comex vaults, and we don't know exactly why that happened, but it happened. And there always with the market, there are many reasons. There's no single reason, but we saw um, more than 200 million ounces moved from London to New York vaults. And I think what you had then was early in 2025, we had the effectively the London markets were going, hey, wait a minute, this was never part of the deal. Um, and the gutting of those, what you call the true free float in London was revealed early in 2025, and it only got worse as the year went on. To the point that they actually had a seizure of trading on October 10th in London for an hour and a half. So yeah, so I would say it was several factors that fed into this. It was years of deficits from mispricing using these paper markets. And when you fix prices, you always end up with supply disruptions, right? When you have a price fixing scheme because you never have adequate supply into the market to meet the market demands. But yeah, so I would say it was the transfer to New York vaults, and we don't know who these vault holders or these silver inventory holders are. If it was an edict that came through from the Trump administration, or it was just observant investors in the New York market or industry that was securing supply, understanding how truly tenuous the global market was. But that was the event that I think set it off, and it's irreversible now. No margin change. Uh, Nothing they do in the New York and London markets is going to make a difference because it's a global scramble. And all they're going to do is the more obstacles that they put in London and New York to the functioning of the markets, the more quickly they remove themselves from the global silver market in terms of a new price discovery operation.
Yeah, and one thing a lot of people would argue, though, is that with the prices going higher for silver, the supply will increase because people will mine more and there will be more supply of silver. And I know that you are in the mining business. Could you tell the viewers why that might be so, but it might take a long time to increase the supply of silver through mining?
Yeah, sure. Oh, I mean, it's the entire structure of the supply chain, right from the exploration side of things to the mining production to the smelters and then to the refineries. My sense is we've got 5 to 10% of the people that we need in the mining industry to deal with what's coming in terms of the demand. A big issue is permitting. That's a huge issue now. And it's strange enough, I mean, it is all relationship based, the work that you do in the mining industry. There's doors that open when people know you and trust you, but not every newcomer or a newcomer does not get the same um, uh, uh, process that a person that has established themselves in the industry and are known to be trustworthy operators. But if you want to look at the entire process from initial discovery, assuming that the exploration drilling goes well, you're looking at 10 years to go from new discovery of a major deposit into production. And then you've got a couple of years of ramp up after that in terms of, reaching stable commercial operations of mining production. So 10, 12 years, right? And as I said, the huge issue is going to be issues such as permitting. Personnel are at the heart of it all, like having the experienced shift bosses in the underground mining who can run these operations, who are certified. Capital equipment, having the equipment available to process the ores. So yeah, it is a horrendous problem to have a sudden rapid onset and demand to solve the problem when the production process is so protracted.
Yeah, yeah, I'd heard that it was more like 5, 7 years, but you're the expert. 10 to 12 years. There you go. We're gonna wrap up, but before we do, just a little bit on what you think the Asian guy is all about. Some people think it's CCP, Chinese Communist Party PSYOP. I've heard someone say that it could be a hedge fund who wants to influence the market. What's your view on the Asian guy? You have an interesting opinion about this phenomenon.
Well, and until I put that piece out a couple of days ago, there'd been no mention of London. Now, since then, there's been two of his pieces that have come out talking about London. So, in truth, the answer is it's indeterminate, right? But what I do know is that I'd say 10 to 20% of what is said by the air quotes Asian guy um, is demonstrably wrong. And the key thing is that these markets, like, the best source of disinformation is one in which, 95% of what they say is true. And only occasionally they come out with something that's untrue. And it's just the clatter of information that's coming out of this Asian guy video is it's creating so much noise that it's difficult to discern what is true. And I'm concerned that in the end that either this source becomes the source for information and then at critical points misleads people, or there's just so much information that's true and untrue mixed in there that people just throw their arms in the air. And it's interesting that Putin used this must have been 20 years ago with his first election, but they used an operative to create confusion in Russia in general with so many controversial things that were going on and that people in the end didn't know what the truth was. They couldn't discern their way out of it. And collectively, a large portion of the population threw their arms in the air and said, well, I don't know. And so when you have mass creation or confusion created like that, it's very, very unhealthy if you're looking to create stability and understanding and choose the best path forward. So yeah, I'm not going to be watching Asian guy. I'm going to be digging through the primary source information and try to get to the heart of what we're seeing. But we're seeing today. I saw this. I had mentioned him earlier. This guy Merckx there, Carol Merckx, Mercx, um, on Twitter or X.com. He's posted the short-term lease rate now, and we see it's surged now to 8.5%, and it's arcing up again. And I think that going into the new year here, Mario, we're back to the original story, which this is all about physical, and it's about a direct possession of the metal. As the stress increases here, we're going to see more and more and more frauds poke their heads out of the ground. It's not just London. It's not just the leverage in New York. There's going to be, and it's not just the ETFs. I mean, it's going to show up everywhere because while people have been sleeping for many decades here and trusting these digital leverage systems, there's been other forces at work that have been taking advantage of the naivete of individuals in the markets. So more than now than ever, it's essential to have these crucial assets in hand. And I think it's not just the silver market, it'll be platinum, palladium, and gold as well, which are traded in London. And along with gold is going to come a bond market problem, ultimately a currency problem. And then we're down to private money in terms of being able to transact for a period of time. We've seen it in Argentina. We've seen it in Venezuela when there's been disruptions that citizens revert back to using gold and silver for exchange. I think governments are going to try to make it illegal, but the governments ultimately are the source of these problems. And I think people are going to have a pretty short tolerance for these edicts that are going to come out of the government sources when the governments have been the source of the problem in the first place.
Yeah, well said, David. And with that, I'd like to wish you a happy new year, also healthy and prosperous, and also to the viewers. And yeah, and we'll keep an eye on the markets and maybe talk again soon.
Thank you. I wish you the same. Health is everything. And let's stay focused on what is to come and hopefully we can help to guide people through some of these the mazes that present themselves in these very, very challenging times that are coming.
Okay, thank you.
Thank you.